I'll actually start recording this as well, and then I can put that on my YouTube channel just in case if
No, it won't discontinue. Don't worry. Nowadays they are still continuing. Even after 45 minutes, it continue, but they may limit it to 100 members. So by the time you are 100, we'll know.
Oh, okay. Last time I think it was asking me that it would kind of it would end the meeting at 40 minutes. Okay. Anyways, I will start sharing my screen. We- I haven't made any presentation to say, but I'll show, for example, how I go out and look for the call options or whatnot, or any options. So I believe most of the people who have joined, they know what the options are. So options is just like, especially if we're talking about call options. Call option is just like buying stocks, but you are not buying the stock. You are buying a commitment or a promise that you can buy that stock at that strike price till that expiry. So a misconception people have is that they have to execute the option. Like if the stock is trading at 50 and they have the call option with a strike of 40, then they can just sell their call without buying the stocks at a premium, at a profit, because stock is trading at 50 and your call option has a strike of 40. That means if you just sell your option right now before expiry, it would have at least $10 in value, and then maybe more if the expiry time is a bit away. So I personally say that do not buy options which have close expiry. I would buy options with minimum 3 weeks of expiry, because that gives you a lot of time so that the stock actually moves in your direction. Even if you're buying put options, I usually normally do not buy put options. I sell put options and I buy call options. So if you're buying call options, buy at least, or what I recommend is buy at least with 3 months expiry. 1 week or 2 weeks expiry option. Yes, if the stock makes a catapult move, you can make a lot of money. But more often than not, you would lose all of your money, because the premium of the like is demand and supply, right? So normally, I have mentioned this earlier as well, that buying a near-term call option is borderline gambling, and in gambling, only house wins. In the long term, if you're buying options again and again, it's very rare that stock would make a catapult move and you would actually make money. In the long run, only the call option seller, he will be making money, because 5 times out of 6 it would not make that catapult move which you are expecting. But if you're buying options which have much longer expiry, for example 3 months expiry, 6 months expiry, or even 2 years expiry. I have bought options last year which had expiry of January 2022, and all of those options, uh, because the stocks had dipped last year, at this time those options have like 5 times or 6 times what they were in last year. And right now also we can see a lot of stocks which have like gone 50% down than their all-time highs. I believe many people posted in the keep posting those stickers in our uh, groups as well, that these are the stocks which have lost at least 50% of the value in this year alone. Like if you look at the YTD chart, year to date chart, uh, there are so many stocks which have lost more than 50% of their values. So in those stocks, if you're buying stocks, we are all buying those stocks in the hopes that they will recover in 5 months time, 6 months time, maybe a year's time. So to one option that rather than buying those stocks, you can buy call options for those. For example, I use this uh, Webull trading, Webull for charting and to see the prices. All of those people who are in Canada, we cannot use Webull for trading, but we can use it for charts. We can use it to see level 2 codes, and we can see it to see the last trades. So and similarly, we can use it for seeing the prices of calls and puts and all those options. So for example, let's start with one of my favorite stocks, which I can recommend right now to buy options, is NEO. as you guys know, many of you might know that Neo stock, I believe in the beginning of January, it reached like 64 or something. And then in March also, once again, it reached 64 or something. Right now it's trading at 33. Yesterday's low or Friday's low was even 31.56. So it has lost at least 50% of its value. One option is that you can go and buy this stock, and then most likely you're hoping that in 5 months, 6 months time, it would go back to its glory days of 50 plus or maybe even 60 plus. If you want to buy 1,000 shares, you need to spend at least $33,000, or even if you buy it on a further dip, like 31 or $32,000. And then your hope is that it would recover in 6 months or 1 year. So another option could be that you buy this stock has options way into the future. For example, the latest option on this stock and many of these big tickers, we have options all the way till January 23. That is 2 years from now. So over here, uh, these are all the strike prices, and this is their bid and ask price, and this is where they was last traded. So one option is that people ask me how far, what is the best strike to choose? Like, should it be in the money? Should it be out of the money? Or should it be way out of the money? So over here, my personal thing which I recommend or which I do is normally.
Ran, sorry,
Hello?
can you share your screen?
Oh, I thought I am sharing my screen. You cannot see my screen?
Not yet, no.
Oh, my bad. Sorry. Let me share my screen. I thought I was sharing it already. Uh, can you share my? Can you see my screen?
Yeah.
Okay, cool. So these are all the strikes over here, and this is bid and ask, and the third column is where uh, you can see what was the last trading uh, price of this option. Another thing, if you're buying options, is to see how liquid those options are, like how what is the volume of those options. Because if you're buying and if you want to sell those, the volume is very little, then bid and ask would have a huge difference, and you won't. It won't be easy to sell those options at a good price, or it won't be easy to buy those options at a good price. So stocks like Neo, they have good volumes in options, and this is apparent from the fact over here that spread is 20 to 30 cents, which is relatively lower when we are talking about options which are about 2 years from now to expire. So people ask that what should be the strike when they are buying the options? Should it be in the money? Should it be at the money? At the money would be like close to this 32, between 32 and 35. And out of the money is anything which is higher than 33. And in the money is anything which is less than 33. So my personal thing over here would be that one thing is that you should buy the option with a strike price where you are hoping the stocks like in 5 to 6 months, and then when you would be looking to offload your options. So for example, 50 in this case could be a good strike to choose. So if you buy the $50 strike price,
Farhan, can you let others in? People want to join.
how do I go back here? Sorry. Oh my God. How do I go back there in the?
You
Should
just
I?
click on
Oh,
participants
participants. Yeah.
and admit all.
Okay.
What platform is this, Farhan?
This is Webull, and I mentioned earlier that in Canada we cannot use Webull to trade. However, we can use Webull to look at the charts. We can use it to see level 2 data for free. We can use to see at what price and at what volume the
Okay.
last trade happened. So this is really good, and it's all free. I think for the first 3 months, it let you see the level 2 course for free. And if that expires in 3 months, you can always sign up with another email. So uh, So I was saying that, in my opinion, the best would be that you pick a strike where you are expecting the stock when you want to sell these options. So, for example, right now the $50 strike price is for about $7. So if you pay $700, you can buy one contract, because whatever is the price over here, you have to multiply it with 100. So all of those people who trade options, they know that whatever is shown over here, to buy one contract, you have to spend $700. So this $700 would give you the right to buy this stock at $50. You do not have to wait the stock to go at $50. You do not need to have $50,000 or $5,000 because one contract, 100 stocks would be worth $5,000. So you do not need to execute this option. So for example, right now, this stock is at $33, but the $32 strike is for $12, right? Because people are expecting that it would go up. So if in 2 months' time, it goes to $50, then $50 call option would be something similar to what we are seeing here. You can see over here, if you go to the right, some deltas, gammas, and theta. Theta is which is working against you each day, that this is approximately how much the option premium would reduce if the price stays at the same level. Delta is telling you roughly how much would the option premium increase if there is a $1 increase in the NEO stock price. So for example, delta 0.6 means that if NEO moves $1 up, this option would move 60 cents up. So if the NEO moves $5, this option most likely would move up $3. So this will change from 960 to 1260. So now one option is that you buy this $50 strike and then you just wait for 5 or 6 months. And if NEO goes to 50 or 60 or uh, whatever, at that time, this option would be much more than 680. You can sell it. Your maximum loss can be only $700 because that is the amount which you are spending. Even if NEO doesn't move or goes down from here, your max loss is $700 for one share. If you're buying 10, then max loss is $7,000. But max upside is kind of, we say it unlimited, because for example, if it goes to 100, this call option would be worth at least $50 and maybe even more because of the time value of the money. Okay. I don't know if it's happening or not. So that is one option, that you go and buy this option with the $50 strike. Another thing which sometime I like to do is that on a dip day, like for example, today, it was on Friday or on Thursday, you buy this $40 strike. Okay. So in $40 strike, you are spending $9.75. We can go and see actually how this options price has been moving up by clicking on the chart. And this would tell you that on Thursday, this was lowest was $8. If we just go about 2 weeks ago, then this was worth $15, right? Over here, you can see low and high. It was actually worth $17 only on 26th April. And since NEO is coming down, this option has also been coming down. Now, you bought this for, let's suppose, $9 or $9.50. So what the strategy would over be here, let's go back to options again and choose the same expiry. What happened? Why can't I scroll down? I think it's my mouse. So if you're buying a $40 strike price, I think I've got puts. Let me go to calls. If you have bought a $40 strike for $9.50, then what I would be looking to do is, like, in 2 or 3 days, if NEO, let's suppose, go to $37 or $38 in like 1 or 2 weeks time, I would be waiting till this $50 strike price hits that $9 price. And that can happen, for example, only on 10th May, this option's high was $9. And if you go a little bit behind that, then it was up to $12. So what I would do is, if you have bought the $40 strike already, then you wait for this $50 strike to reach the same price. Once it reaches the same price or a little higher price than where you bought the $40 strike, you sell the $50 strike. So that way you capture or you regain all of the money which you spent when you were buying the option.
Finish.
So So you spent $7,000, or you spent, in our example, let's go back to the $40 strike. So in our example, you spent $9,500 to buy 10 contracts of $40 strike. Okay. So you need to have at least $9,500 in your account. Now you wait for 10 days, 15 days, 20 days, however days. And when the strike of this $50 call reaches the same price or price higher than what you paid for $40, you sell the same number of contracts for the $50 call. So what you have done is that you, whatever money you spent, you have taken all of that money out. So in your account, it will show that you have 10 options for $40 strike, and you have sold 10 options for $50 strike price. And you have spent zero money of your own, because whatever money you spend, you have taken all of it out already. And after that, it is just a waiting game. You just, and how this option premium works is that as the price of stock goes up, $40 strike, which you have bought, that will also go up. $50 price, $50 strike, that will also go up. But eventually, near the expiry, or the rate of increase of $40 strike would be higher, and the $50 strike would be lower. So, for example, let's come to options which are expiring soon. So in this strategy, you have taken all of your money out already, maybe a little bit of profit if the strike has actually gone up. So now let's look at the option which are expiring next week. So once you've taken all of your money out, you can just wait for a year or two whenever the options are about to expire. So now look here. If, for example, you had a $25 strike, you had bought it and you had sold this, you have bought this one and you have sold this one. So difference between these two strikes, 7.9 and 3.7, how much is that? $4.20. So you will close both of these options and you will net $4.20. One is 25 and one is 30. So basically, whatever is the difference between the strike, that could be your potential profit or max profit. So you spent $0 of your own, like you took all of your money out after 1 week or 2 weeks, and when the option is very deep in the money, or when it is close to the expiry, the difference between the two strikes would be your profit. So you had $40 strikes and $50 strikes. You had spent zero money of your own, and you could be looking at $10 per share. That would be $1,000 per contract. So if you have 10 contracts, that would be $10,000 profit without, and you have not invested any of your money. You have taken all of your money out. Your risk is zero, and your max upside is $10,000. That is if NEO crosses $50 uh, in January 23 or whenever the expiry is. This was a very extreme example. Very far into the future, you can do the exact same thing with January 22 options as well, which are like which are out, which are like I believe about 7 or 8 months out still. So if we look at January 22 options, over here $40 is just for $5 and $50 is for $3. So you buy the $40 one now, you wait for a few days if the NEO goes up, and when the this $50 also crosses 5, you sell those. Or that is one way. The other is that you say, okay, no, I do not know if the NEO would go up or how far, when it would go up. You can buy $40 calls now and sell the $50 calls also right now. That would cost you $2 per share and $200 per contract, because you will be spending 5 to buy and you will only get $3 to sell. So you're spending $2 per contract. But in January 2022, if the NEO is trading above $50, each of your contract would be worth $1,000. So you're spending $2 and your max upside is $10. Your max loss is $2 in this case. But I would personally recommend that you buy these $40 strikes and you wait for a few days. If NEO goes up, most likely it will go up. That is why most of the people are buying NEO stocks now, or like any of these stocks which have come down significantly. Then you sell these $50 one and recoup all of your money, and then just hope and pray that NEO keeps going up. You do not have to wait till expiry. You can close the contracts before that as well, but the max potential can be when it is close to the expiry. Did everybody understand these two or three examples I gave, to these two or three strategies which I suggested to buy and sell call options? If we are okay on this, then we can move on to some of the other tickers which I can recommend or which I think are okay or good to buy call options. Let me actually stop sharing my, I want to go back to meeting. How do I go do that? I don't know. Okay, you're good. This is vertical spread, right? Yeah. These things are vertical spreads, I believe, or just spreads. Okay. Any questions? Okay. Let's move on to some other tickers which I believe are good to buy.
फरहान
Yes.
एक क्वेश्चन है
Yes.
इस पे ये है कि तो PLTR का स्टॉक जैसे अभी $20 पे ट्रेड कर रहा है और अगर हम उसको PRT को परचेज करते हैं $50 स्ट्राइक प्राइस पे एक साल पे तो उसका प्रीमियम क्या होगा और
वो
जब ये
यहाँ पे
बढ़ता है
yes, we can see it over here. So for example, January 22 आप चले जाएं, या उसकी जून की ऑप्शंस अवेलेबल अगले साल जून 2022 की, और लेटेस्ट सबकी जून 23 की सारे इस लिक्विड बड़े
जैसे $50 स्ट्राइक प्राइस हो जैसे वो $20 का भी और $50 स्ट्राइक प्राइस पे करते हैं और एक साल की एक्सपायरेशन देते हैं तो उस पे प्रीमियम हमें कितना देना पड़ेगा?
So over here it is showing that for January 23, which is 1.5 year from now, premium is $2.15.
तो
Okay.
पर शेयर हमें $2 देना पड़ेगा और इंस्टेड ऑफ स्पेंडिंग $20 हम $2 पर शेयर के हिसाब से शेयर खरीद सकते हैं कि $50 पर परचेज करेंगे प्रीमियम वी आर जस्ट पेइंग टुडे इज $2.
Right. But okay. So yes, exactly. That's how you said it. But let's take a look at this PLTR example as well. So when you are looking at what strike to buy, and other thing is that you look at how much is the difference in premium. So $50 is $2.20. 47 is $2.28. 45 is $2.50. This is where the last traded, and actually let's look at the ask, because that is what is the price you have to pay if you want to buy. So 50 is at 2.25, 40 is at 2.26, 45 is at 2.61. So basically 50 and 45, the difference is how many cents? It's like it's very minute, if I may say. It's less than 40 cents, huh?
Okay.
So in this case, what do you think? Was it better? Is it better to buy 45 or is it better to buy 50?
45.
Yeah, because you are only paying 45 cents more.
Okay,
You are
and you are
increasing
getting
your profit
$5
by
extra.
$5. So
Exactly.
once the options are way out of the money, their premium actually that is, we say, diminishing effect keeps coming in. So if you start looking at the premium from here, I would say pick a strike where the premium difference is like going to
Even like हम 27 पे buy कर लेते हैं तो just we have to pay $5,
So I would
right?
say
और जैसे $27 से ऊपर जाएगा तो that will be our profit. $27 से बढ़ जाता है strike price $27 है और ये $40 पे हो जाता है तो differential हमारा जो profit हो जाएगा from $27 to $40.
And another thing which I would say is that if you buy this option right now, it doesn't have to go to 27 to make you profit. Even if it goes to $22, this option would increase significantly. This would be at least $5.50. We can actually let's take graph actually. I wouldn't buy 27. I would buy 30. Usually the strikes which are like 25 and 30, those options would have normally more liquidity. But it depends when you are at that time. What is the good ask? Where is the good ask? If the good ask is here, then maybe buy this one, otherwise maybe buy this one. Let's take a look at this graph.
फरहान,
Yes.
आप ये न्यू को जो है ना वो सेल पुट के पर्सपेक्टिव से भी बता सकते हैं थोड़ा सा?
Yes.
हाँ जी.
Sure.
तो ये 1 year की एक्सपायरेशन थी जो PLTR की थी $5.27 पे.
No, this is 1.5 year. This is
1.5 year.
January
तो 1.5 year में तो PLTR लगता है हो सकता है $100 को हो जाए तो बहुत सस्ते में मिल रहा है.
Yes. if you just go, for example, look at this option, then this, I think over here the stock was trading around $24 towards the end of April. So $24, this option was $6.30. So
फरहान चेक कर लीजिएगा कोई क्यू में हो तो उनको रूम में आने दीजिएगा.
I don't think we have any right now.
Okay.
फरहान, just one question. मुझे पता है आप ये सेशन रिकॉर्ड कर रहे हैं, तो ये रिकॉर्डिंग का लिंक आप लोग पोस्ट करेंगे ना ग्रुप में?
Yeah, sure. I have a YouTube channel. I'll put it on there.
Thank you so much, because I joined a few minutes late, so I just wanted to ensure that I am able to cover up what I missed. Thank you.
Yeah, no worries. So,
Okay, Farhan bhai, I'm having a question. Okay, I think maybe many people will like.
put the questions in chat, because otherwise it would be difficult to kind of continue the session. So put the questions in the chat, and running out of time. See, it's gonna finish in 10 minutes maybe.
It will add value. Okay, you will appreciate it.
Just
Give me 1 minute.
Will end in 10 minutes. Okay. Yeah.
Okay, the question is that I think people will like it, that why you are not selling $50 and buying buying $50, which is cheaper, and then selling $40.
Then that means if the stock is above $50, you will lose $10 per contract.
Exactly. Yes. So we need to buy basically which is close to money.
You need to buy the lower strike.
And calls, and sell it up, which is a further one.
Yes. So buy the lower one so that you can buy the stock at $40 and theoretically or hypothetically sell it at the $50 one. So even if it is, you do not need to be like, it would still be in profit even if it does not cross 50. Even if it's at 47, you will be $7 in profit. If it's at 45, you would be $5 in profit. If it's at 42, you would be $2 in profit, and so on and so forth at the expiry. So anything which is above the strike from where you have bought it, that will be your profit, but it will be capped at 50, because at 50 you have to give it to somebody else. That is what you sold for, right?
Yeah. And in case of the put, it need to be opposite. Again, close to the money we need to buy and sell the one which is further away.
Yes. So
yes.
Normally the reason I did not discuss puts is because selling puts is a bit more risky. You need to have bigger margin. So I think in Canada, all the banks, they require to have you at least $50,000 in the account if you want to sell puts. And also over there, there are some restrictions that how much margin it does. Because in the puts is a bit more risky, or less people sell puts than people sell calls. So maybe that's one of the reasons. Usually if I am doing this call options thing, I would buy the call options first and then sell the higher strike. Or you can wait it out. So just because we are like into 3, 4, 5 minutes, so some of the stocks which I would recommend where people can buy call options, where the stocks have dropped significantly. We have talked about NEO, we have talked about PLTR. Another one is AI. So AI, I believe it opened up around 100 on the day one, and then it was trading above 100 for so many days, and now it's trading close to $50. So for this stock, you can buy options. Again, let's go to 1.5 year into expiry. So you can buy even $80 strike. Sorry, $70 or $80 strike. $70 is for $12.30. Yeah, I would say 70 is good because it's $12.30. And if the stocks goes back to even 60, at that time you would be able to sell $80 or $85 option at the same where you are buying the $70 one. Another one is FSLY. So this stock was trading for the most part of the last year, like after September when it went up, it was above 100 for so much time. Then it was trading around 80, 90, and then over here it was trading around 60. Now it has come down to 40s. So for this stock also, if you can buy options for January 23, even I would say $50 is probably good. But look at the options; it has all the way till even $200. So $50 or $60 is for like 55 is $10. And then I believe if the stock goes above 50 or something in 2-3 months, then $70 would be same as $50, and you can send the $70 one. So AI, FSLY, Another one is Sunrun. Sunrun was also, I believe it went above 100, close to 100, was there about $90, and now it's close to $41 for this stock also. All of these stocks which I am mentioning, I would recommend buying options for January 23, which is about 18 months from now. These ones are actually cheaper than what I thought. So $60 is 7.5. And then I would say wait till it goes to 50. At that time, you would be able to sell maybe $75 or $80 one for the same one. Neo, PLTR, Sunrun, FSLY, and what else I have here which has gone down significantly. Another thing when you are buying options is look for the stocks which have a very high short interest. So whenever the stocks have very high short interest, sometimes, you know, we all have heard about this term short squeeze. When that happens, the options price just skyrockets. This happened in RKT. I had rocket stocks when it was trading close to $21, $22. And I believe over here they announced their earnings and then it triggered a short squeeze. This went to from $22 to $43. So just imagine if you had bought the options for like even $25 strike, they would have gone like 4 times or 5 times in a single day. So any stock which has very high short interest, buy its options for 1 year and 1.5 year out, and then just wait in 3 months, 4 months, whenever the short squeeze happens, those options would just kind of skyrocket. Since you do not know when it would happen, but we know that it is going to happen. So if you have bought the options for 1 year, 1.5 year, it would happen in during that time, and then you will be good. Tesla, I would say, but Tesla options are extremely expensive. Usually, most of the options I think would be above $100 or $150. So one contract would be $10,000 or $15,000. So so that could be a bit risky, and not many people would have that kind of money. What are some other stocks which have gone down significantly? We can look for their options, and you would find, I think, something similar. So I think Plug, some people had mentioned. Yeah, so Plug was trading also just like Neo, even above $60 or $70. Last week, I believe it went even below $20 on Thursday or something. So if we go for options in this one, over here also the options are relatively quite cheap. So the $40 option is just for $5. I would say maybe buy $35 one. So that's for $7. And then just wait for Plug to go back to even 30. You do not even need to go back to it. You do not need it to go back to 60. Even if it goes to 30, you would be able to sell a higher dollar strike, a higher value strike for the same amount of money that you have invested. Yeah, so these are some of the tickers which I can recall where fundamentally nothing much has changed, but because the hype have reduced, stock prices have come down significantly. But usually, if the fundamentals have not changed, stocks tends to go back to their previous highs. And once they go back to their previous highs, you would be able to sell it. Yeah, RMO, I am unfortunately holding a lot of RMO stocks. And yes, RMO options could also be much cheaper. Maybe QS as well, but RMO, I know I am holding some of the stocks, so I have not bought the options, but I understand that the options might be very, very cheap at this time. And RMO did that thing 2 times in the past, that one day from, I believe, $8, it went to all the way to $13.50. So if you're buying the options now, you wait for a day like that, and then your options would like maybe 4 times or 3 times in a single day. Yes, look at these. Oh, this, okay, so for RMO, actually, uh, the latest options available are only about 6 months or 7 months from now, from 17 December. And look at this, they're really, really cheap. Like 7.5 is also $1.50. And as you know, RMO was a SPAC. So majority of the people have bought this stock at $10. or even higher. This all-time high for this stock is $34 or $35. So right now, if you buy $7.50 strike, you only have to pay $2. So maybe I would say for this one, buy a call option for $10 just by spending $1. And if it goes to $10 in next 2 months, this option would be doubled or maybe even tripled. Another one actually is NNDM. I don't know if it would have January 23 options. Yes, it does actually. So NNDM also, I believe one of the last days it was only it was below 550 or it was close to 550, and its all-time high is close to $16 or $17. And I believe this stock also has a good short interest and